let's all welcome Jeff to the call. Jeff, if you want to go ahead and unmute yourself. Jeff has been a financial planner of ours that we've used, not only personally, but a lot of our clients have had the opportunity to work with Jeff as well. So I invited Jeff on the call today as our first trusted professional presenter. So we are going to record this call and put it in the financial planning aspect of the e-learning platform, along with the slides that Jeff has been so gracious to offer to us. So I'm going to pull this up here and we will get started. All right, Jeff, how are you, man?
Good, doing well, and really excited to be on this call. I haven't partaken much into the art of home ownership yet with you guys, but I know we refer a lot of business to you, and you refer a lot of business to us. And I know that the whole crux of art of home ownership is really creating those synergies between the various professionals that you showed on your screen earlier, Ryan. And I don't know, again, who's on this call, but as a testament to how we work together, your firm and my firm, we did 16 loans together, I believe, on your side last year. And we had, and uniquely, 4 of those were actually referrals originally from you, then a referral back from us because they were updating their financial plan. And so for those of you who are listening in on the call or the recording, having a independent, trusted advisor or myself, certified financial planner to work with, the synergies there really can blow your business up. And the referrals that you get from somebody like myself, and Ryan can speak to that, we're not comparing rate. It's not just a game of rate. It's a game of service. It's a game of continuity. And it's more about how much loan do you need for the home you're trying to purchase, whether it's an upgrade or a refinance or even a couple reverse mortgages last year. So.
Yeah, thanks for that, Jeff. For everybody on the call, and just so you know, Jeff, this call is going to consist of mortgage professionals and real estate professionals around the country. And so, everybody on the call, obviously our goal is to provide an unimaginable amount of value to the people that we serve, right? And our value does not start and stop with the mortgage, right? Our value is that we're going to help them make and save more money than any other real estate or mortgage professional they've ever come across in their life. And we can't do that alone, right? We know the questions to ask and we know what to listen for. And then we need to be able to put them in touch with people like Jeff and our financial planners to have that really, congruous partnership where I can say, look, I think you can use some improvement here. Talk to Jeff. They love Jeff. Jeff helps them do amazing things financially and set plans and strategies. And then every year as Jeff is doing his financial analysis, when he sees opportunities or needs, he puts them back in touch with us if we're not already, figuring that out for ourselves. So, again, not just financial planners, estate planning attorneys, CPAs, all these people need to be a part of your trusted professional network. And Jeff will give you an example of that here. So Jeff, today we want to help everybody understand what to look for and when speaking with a client, knowing that everybody's going to have, clients that are, multimillionaires all the way down to clients who are, putting zero down and getting down payment assistance and are barely scraping by to be able to afford a home. So like I always tell everybody, it doesn't matter how much money you make, it just matters how much money you keep, right? And then ultimately what you do with the money you keep. And so I wanted to bring Jeff on because obviously we've gone through the questions to ask, right? We all have the client intake in the initial and annual financial review document. So we know what questions to ask. And then Jeff's going to tell us, as people are answering those questions, what to look for, what comprises a really good overall financial, a sound financial portfolio, and then some ways in which you guys can ultimately, extract that and refer it out to your financial planners in your markets. So, Jeff, you just let me know and I'll click through here and we'll get started on page 1.
Yeah. So looks like, Ryan, you are using, perfect, the one that we have designed here. Great. So first thing we always want to look for when we're meeting with anybody, especially when it comes to helping a referral from somebody like yourself, or more importantly, when you guys are asking questions is cash flow planning, right? Cash flow planning is exactly what you guys do on a daily basis for all of your clients. But with cash flow planning, we want to give every dollar a job. And then when we give every dollar a job, more importantly, what we want to do is say first, as we're looking to typically increase cash flow or at least increase liabilities by assuming a mortgage, we also want to look at protecting that cash flow. And then we'll get into tax questions and retirement and investing questions. So Ryan, if you want to go to the next slide where we talk about, okay, this is a little bit about myself. So simply put, I'll make it quick because I know we're not on here to talk about me. Graduated from Cal Poly, been in the business for 16 years. Recently, for the last 3 years running, we've been ranked as a top 100 financial planning firm in the country. And I've also been recognized in the top 1% of advisors. So moving along.
So Jeff knows what he's talking about, people.
Yeah, so first thing is we like to have this sequential order of disposable cash flow. Give every dollar a job. So the first thing we would talk about is protection. And protection is typically in the form of insurances. We then evaluate emergency funds. So as you're asking questions to your client, one of the main what we want to get you guys away from doing is just accepting yes. Hey, do you have insurance? Yes. Okay, great. And then you check the box. That's not what we're here to establish. We're here to establish a secondary set of questions that allows you to look like more of a professional in the field of money. That's what we're all dealing with here, the field of money, right? So for protection, do you have insurance? Yes. What types of insurances are out there? There's disability insurance. There's life insurance. There's long-term care insurance. There's homeowners insurance. There's auto insurance, and there's umbrella insurance. And we're going to go through a couple extra set of questions on each set of those insurances. The next thing that we look at when we talk about the sequential order of disposable cash flow is the emergency fund, keeping 3 to 6 months of monthly expenses. I think a lot of people have heard this concept, having and keeping an emergency fund. And the reason it sways from 3 to 6 months is simply dependent upon how your income is generated. So as most of us on this call, mortgage professionals, you don't have a regular income like you would if you're a school teacher or a firefighter or a policeman. So when you have an emergency fund of somebody who is more of the commission oriented base, you want to shoot for that 6 and maybe even 12 months. For those realtors out there, we like to see 6 to 12 months of monthly expenses, Ryan, simply because you never know when those escrows and those deals are going to be closing. So we'll talk about that. Then as we go down this list, we start then looking at saving for retirement, and then furthering that savings to say, once we're saving for retirement, are there other short or intermediate and long-term goals? So Ryan, if you want to move to the next slide, that'd be helpful.
Yeah, so guys, just to touch on what Jeff said, the questions we ask are important, but if someone says, yeah, I have life insurance, please don't just say, okay, great, and move on, because that's not going to separate. I mean, first, just asking the question will probably separate you, but if you really want to show A, that you care, and B, that you want to establish a legitimate holistic financial plan for them and help them in every aspect of real estate or finance, you need to ask the follow-up questions. So just knowing these 5 bullet points is great, but knowing the intricacies of the 5 bullet points is going to help you even more. And 1 to 2 extra questions can make the difference between the advice or guidance that you give them, right? The amount of home they end up buying, the mortgage size they end up taking, the down payment amount that they put down on a home. So all these things are extremely important, because when you think about it, if we just let someone buy a home and don't talk about insurance and protection, they find out 6 months later, they end up talking to a guy like Jeff, and he says, you need life insurance, you need disability insurance, you need this, that, and the other. And they say, I can't afford any of that. My mortgage is too high. Right, well, then they bought too expensive of a home, right? And if anything happens, they then lose that home. So again, ask the questions, look for the right answers, and that's why we're having this discussion today, so you can understand what those answers look like.
Great. So let's unpack some of these. So where should I put my cash savings or emergency fund? And I like this, right? Not in the floorboards or not under the mattress. So when we look at cash savings and emergency funds, a lot of people typically just keep that money in their checking account. Some people keep it in their savings account, but more than likely we see people keeping that money just in their checking account because that's where it gets deposited from their direct deposit, right, from their employer. There are many high yield savings accounts out there that yield 1.5 to 1.75%. This may not sound like a lot, but again, when you, the trusted advisor, can say, hey, as you're establishing your emergency fund, where are you placing this money? Are you leaving it in your checking account, or are you leaving it in a savings account? And then what are you yielding on that savings account? So a good place to check high yield savings accounts, bankrate.com. Okay, great place to go to say, what are bank accounts yielding? And you'll notice that a lot more of these online platforms, online banks are giving you a higher yield. And at the same time, they have maybe a 24-hour turnaround of payment cycle, meaning if I need to take money from my online bank to my Wells Fargo account, because that's where all of my monthly electronic fund transfers occur, Ryan, that's exactly where we can just transfer money over there and then have those bills come out. And I know, again, that 1.5 or even certificates of deposit at 2 or money market accounts at 2% doesn't sound like a lot, but when you have an individual that has a monthly outflow or monthly expenses of $8,000 and they have 4 or 5 or 6 months saved, I'll take an extra 5 or 6 or $700 a year. That's good by me, right? I mean, I can go to maybe Disneyland for a day. So this is where we first look to put those emergency funds, and use bankrate.com again. Great place to go. Moving on.
Did you talk about CDs or money markets or bonds?
Yeah, money markets are a great place to keep money. I do like certificates of deposit when somebody has more than 6 months of emergency funds. The reason is certificates of deposit, you're making an agreement with the bank to keep the money there for 3 or 6 or 9 or 12 months. So typically we first say, let's look at those high yield savings accounts. Then if they have more and they yearn for a larger emergency fund of 10 or 12 or 18 months, then we investigate the certificates of deposit. Money market accounts are they're almost synonymous with high yield savings accounts. The only difference between money market accounts and a high yield savings account is money market accounts will restrict you on the amount of transactions you have to do on a monthly basis. And that's typically 3 transactions. That's just going to be predicated from bank to bank. So, those are really the 3 main areas we like to see emergency funds. As again, people like to have more security. This is to take your retirees typically. Then they can investigate bonds, and bonds yield much more than high savings accounts and certificates of deposit. But again, be careful on the types of bonds you get into. So I don't really want to confuse the situation by going too deep into bonds, yet to
Yeah.
say, go online and look at savings accounts and come up with a couple banks like B of I, Bank of the Internet. Okay. That's a great place to start. We have a lot of clients who use that account, a lot of commercial clients who use that, and they're paying 1.7% right now.
Yeah, guys, CIT is another pretty good one. CIT is at 1.8% right now with no minimum and, fully FDIC insured. So, I'd say, like Jeff said, pick a couple of them and if nothing else, you can tell someone in one phone call or one meeting, hey, I just made you an extra, $1,000 a year, right? But if you do nothing, just do this, right? So you want to show value out of the gate, and this is a pretty good way to do it.
Yep.
All right.
So this is the area that I become most passionate about, especially when I speak about cash flow planning. The number one biggest killer in any financial plan is loss of income. We all plan around the exact amount of income we have. Hey, my wife and I work, we make, 8, 10, I don't know what the number is, but they make a certain amount of money. And typically people are living on 80, 90, 100% of that income. So they are reliant upon that income. seemingly until they're age 65 or older. And so the number one question, if I were a mortgage professional or even a realtor, the number one question I would ask to add value is, now that you're going to be making this purchase, do you have long-term disability insurance? And the individual or the client may look at you and say, that's an odd question. But again, it shows that you care. Long-term disability insurance simply allows somebody, if they become disabled, to supplement their income until they get off of disability. This is the number one risk. Not, quite honestly, it's not death, right? The odds of death are literally 4,000% lower than you going on long-term disability insurance claim. All right. So what is long-term disability? Simply put, long-term disability says if you become unable to work or perform your job function, then they're going to typically pick up 60% of your current income. And sometimes that's paid to you tax-free, and sometimes that's paid to you taxable. And the only thing that differentiates the two, just for your own edification, is if you, the client or the person, pays for the long-term disability insurance out of your own pocket with after-tax money, well, it's tax-free. If your company pays for long-term disability insurance for you and it's pre-tax, well, then all of it's taxable. So these are things that, as you've asked the question, do you have long-term disability insurance, you want to ask these second questions, these two questions that we have on the screen. So, Mr. and Mrs. Client, do you have long-term disability insurance? Yes, I do. Don't stop there. Ask the two questions. What's the definition of your policy? Well, there are two definitions, and this is going to blow your mind if you guys don't know about long-term disability. It also shows you why insurance companies have more money than banks and oil companies combined, though. They always get you with the language of the policy. So there are three basic definitions that we look for. Number one, own occupation. What is own occupation? Well, it refers to you being able to perform your exact same job. So Ryan, you're a mortgage professional. You talk to people a lot. You have to calculate numbers a lot. So if you are unable to do that job because of a disability and you have an own occupation stated definition, then your policy would pay out. However, the cheaper variety of long-term disability insurance is called any occupation, which means that some policies will not pay benefits if you can perform any occupation you are suited to. Okay, so let's consider this, Ryan. You have to use your brain a lot, you speak a lot, and something happens and you lose your voice, all right? But you can still perform a lot of functions, like you could be a court reporter and go type on a computer all day. That's any occupation. I'm sorry, Ryan, your disability policy would not pay out. So again, you want to ask that second level of question. Mr. and Mrs. Client, do you have long-term disability insurance? Yes. Great. Do you know the definition of it? What does that even mean? They're probably going to say, well, there's own occupation, any occupation. If you just stopped there and said, you know what, let me get you in contact with somebody to look at your long-term disability insurance policy, you've added benefit. If you want to take it to a second level, what age does your policy pay to? A lot of policies actually will incorporate Social Security disability insurance in there, which is an offset. So said in layman terms, again, the shorter duration of the policy, the cheaper it's going to be. You guys all get people's pay stubs. I know you do. Look on that pay stub. It'll say right there if they have disability insurance through their employer or not.
So Jeff, on this topic, let's say, I'm talking to you and I say, well, you're the mortgage advisor. You ask me, Ryan, do you have disability insurance? I say, pretty sure I have a policy through work, right? Then you would say, okay, do you know if it's own occupation or any occupation? Those would be the questions you ask, right?
Yeah. Yep.
You'd ask, and do you know at what age it pays through?
Yep.
And would you ask what percentage of your income it covers?
You could definitely get to that third question. Absolutely. I'll say this, the typical group employer sponsored plan does cover 60%, but okay. I do think that is a great question. I don't know how deep in the weeds you guys want to get with now becoming a long-term disability insurance specialist. But again, I think with those first two questions, it at least opens that conversation up to say, I don't know, which is the typical answer. I don't know these things. And then you say, well, you should. Let me get you in contact with one of our trusted professionals to help you evaluate this if you don't know these answers.
Yeah, and I think that's the key that we're trying to accomplish here, everyone, is that, by asking these questions, you have to say, look, Mr. Smith, the reason I'm asking is because the last thing I want to do is give you a $2,500 housing payment, and then your income, if you become disabled, that your disability income doesn't cover that, right? And then you lose the home, right? Or you have any occupation as opposed to own occupation, and then it doesn't cover anything at all. So again, I'm not selling you insurance here, but I think it's worth you having a discussion with our financial planning team so they can at least analyze that for you. Would that be something that would be helpful for you when you're going through this process?
Yeah, and Ryan, do we have a minute or two for an example, or do you want to move on?
Yeah, you can give me an example. We got time.
Yeah, so I got this email this morning from the California Judges Association. I would regard judges as pretty smart people, and I would think that judges would be pretty well covered considering they are pensioners of the state of California. Let me just read to you the first line that came over on the Judicial Disability Coverage Fact Sheet. Disability does not begin until you have held office for 5 years. So if someone's a new judge, they don't even have disability covered until they hit their 5th year, right? These are the little intricacies that we like to look for. So she's sitting here thinking she's got disability coverage. I said, oh, just get me the disability coverage policy. Now she realizes, wait, I don't have coverage until I hit my 5th year on the bench. I mean, that's a long time. So anyway, that's just some of the things that we get into the weeds with our clients on.
And Jeff, if someone says they don't have insurance, say you ask me, say I actually don't have disability insurance, Jeff, what would be your response to that?
Yeah, so the typical cost of a good disability insurance policy should be anywhere between 0.5% to 1% of your current income. So I would say first, you should go out there and investigate that, because don't you think it'd be a prudent thing to do for you and your family to pay 1% to cover the other 99?
Yeah, guys, this is a key reason why the art of homeownership exists, right? It's because I think that by just selling people debt and not making sure that they're appropriately taken care of in every aspect of real estate or finance, it's irresponsible. So if we ask these questions and help our clients really set themselves up for long-term success, not only is it great for them, but it's going to help you sleep at night. All right, I'm going to move on from any questions on disability insurance that anybody wants to ask? Or up to this point, any questions anybody wants to ask on, emergency funds or disability insurance? And feel free to type in the chat box as well. All right, we're going to move on here.
I think we've all put them to sleep with disability insurance, as necessary as it is. Sometimes it can get pretty in the weeds. But
Right.
again, I love the cash flow planning part of it, and it's a really important part of cash flow planning. So other necessary insurances, Ryan, that we go through: life insurance, especially you take your new homeowner, or you take hey, I'm a first or second time home buyer, this can be my first or second purchase. Let's look at getting term insurance. The typical term insurance that you see out there on TV and radio ads and all that stuff, they are giving you quotes for 10-year term insurance. Let's back up for just a second. What is term insurance? Term insurance simply says if you pass away within the next, in this example on the screen, 30 years, your family or your beneficiary will receive $1 million tax-free. So it's a term. It's like renting. It's not owning. There are two different types of insurances in this world. There's term, and then there's permanent. Permanent lasts until age 120. That's more expensive than renting insurance for 10 or 20 or 30 years. When we look, though, at life insurance, we look at all of their debts. We say, okay, hey, you've just assumed a $500,000 mortgage. Okay, what other debts do you have? Car notes, Would you also like to provide an income for your spouse and your family in the case of your passing? And so when we add all of those things up, Ryan, we come to this number: 1 million, 2 million, 3 million, 4 million. It's all dependent upon what we're trying to cover. All right. And so I personally really like 30-year term insurance. I know a lot of things online you see there, it's all about how cheap can you buy the life insurance. In this world, you get what you pay for. So yes, if you pay $10 a month for life insurance, you're probably only get it for the next 10 years. So if you assume a 30-year mortgage, but you only buy 10-year term insurance, tell me what's going to happen in year 11. Are you just going to try to go buy another insurance policy when you're 10 years or 11 years older and you don't know what your health situation is at that point? So I personally, when I'm doing cash flow planning, I really like to look at least 20-year or even 30-year term insurance. It covers the cost of that mortgage. And if you have kids, some college funding. Anyway, the cost for these term insurances, and for a 35-year-old female, it's approximately $100 a month. So again, when we go back to cash flow planning and we say, okay, disability insurance, some life insurance, we're still not spending more than maybe 2 or 3% of someone's income, Ryan, to really cover the full loss of income. Okay.
Got it. And Jeff, we had a question in regards to elderly clients. Would you recommend disability or life insurance for elderly clients? And I'm fairly certain the answer is going to be it depends, but how would you answer that on your end?
Yeah, so I agree with you. It does depend, but I don't want to just give that answer because that doesn't help you, Stacy. Disability insurance can only be obtained if you have earned income. So if you're working and you're 63 or 64 or 65, yeah, if you have a financial plan that says you got to work until age 70 or 72 and you won't be able to retire, or you're going to run out of money at age 80 if you don't work until 70 or 72, absolutely I would recommend disability insurance. Stacy, thanks for chiming in here. More thinking 40 to 50? Absolutely. I can't think of a 40 or 50-year-old person who, if they lose income, their financial plan still works. Their funding of college still works. Their ability to live until age 90 or 95 still works. So yes, I recommend disability insurance for all of our clients. Because again, when you're spending 0.5% or 1% just to cover that income loss, yes. When it comes to life insurance, absolutely. Absolutely, we recommend life insurance to all of our clients. I can't think of a 40-year-old or 50-year-old that I know that owns a home fully free and clear. So if you have an encumbered home of $500,000, unless you've got $500,000 sitting in the bank or more, then yeah, you're going to at least want enough insurance to cover your debts, Stacy. Here's one rule of thumb that we use. So if you guys have a notepad, this is really fun to write down. Do this for yourself. Figure out how much it costs for you to live on an annual basis. So if it costs you $100,000 a year to live on an annual basis, then, and obviously these are more California numbers than I'd say across the country, but if it costs you $100,000 to live for the year, you need a pot of money that can generate $100,000 for you every single year when it comes to life insurance. So for me, I carry $2.5 million of life insurance, which invested at 4% will generate $100,000 a year, Ryan. So now my spouse will have a guaranteed income of $100,000 a year tax-free, because life insurance is tax-free. If invested properly, it can be tax-free as well. She'll have $100,000 of income for herself if something happens to me. Stacy, I hope that answered your question. If not, we can take this offline and further that conversation.
Yeah. Any other questions about life insurance, home, auto, umbrella?
I'll get to home and auto in just a sec, Ryan.
Oh, got it. Okay.
So if we don't have any questions on the disability and life, then we'll move on here. So homeowners, auto, and umbrella insurance. We recommend at least $300,000 and $500,000 for auto bodily injury. Simply put, what that means is $300,000 is for per person, for the person, $500,000, that number is for the aggregate. So if there's multiple people in the car, okay? People never really understand why there's two different limits there. It's per person on the left-hand side, the 300, and then the 500 is the aggregate number for the entirety of the bodily injury in the car. Where we see the biggest holes is not auto. We see the biggest holes in homeowners insurance. And I'm going to pick on the state farms and the farmers and the big basically three that you see all the ads on TV. Okay. Homeowners policies should have building code upgrade on them. If you are somebody in California, you got to have homeowners building code upgrade. California changes its building code more than any other state in our country. And what building code upgrade says is if you go buy a home that was built in 1987, something happens to it. Do you think that building code hasn't changed since 1987? The height of the windows has moved up by 6 inches. Building code upgrade, if you have to move windows up, Ryan, the insurance company is not going to cover that because you don't have building code upgrade. You say that cost is yours. We'll repair the wall, but you're gonna have to pay for the window to be 6 inches higher, or for now if you have more than a 25% damage to your home. Now that it's 2020, California is going to require you to put solar on your home. Okay. Lastly, personal injury. Personal injury is slander. Okay. I rarely see personal injury on a homeowner's policy. Here's how simple personal injury is. In social media, with tweets, Facebook, all this stuff, if you send a damning tweet or Facebook post, think of your high school students cyberbullying, you can get sued for that. That's all personal injury. That's libel. We see more lawsuits in this respect than any other homeowner's claim by maybe even 100 times. So this is a big one, Ryan. This is a big one with social media now. Personal injury.
Good to know.
Yeah. And then lastly, when we talk about elderly clients, going back to those questions, hey, Mr. and Mrs. Client, do you have long-term care insurance? This isn't an insurance that you have to have. You know, we all have to have homeowners. We all have to have auto. The long-term care insurance, you have clients over the age of 55, ask, hey, do you have long-term care insurance? So while we talked about disability insurance being the number one killer to a financial plan, as somebody enters retirement, the number one killer to their retirement plan is long-term care insurance or a large ongoing health costs.
Yeah, and as you guys are talking to any of your clients, it's always good, especially when we're talking about generational wealth planning. This is a good question to ask is, so if you talk to your parents about generational wealth planning, most people aren't going to know what that means, right? And so it's okay. I mean, in terms of their real estate and retirement, do you think you'll be inheriting any assets at any point? Do you think that, are your parents going to have enough money to make it through retirement? Do you know if your parents have long-term care insurance, right? Because if they don't, that problem then becomes yours, right? And it could affect your home, livelihood. So again, all great questions to get people to start thinking, okay, wow, there's a lot more to this than just what's your rate, what's your term. And start realizing that you have their best interest in mind from a big picture perspective. It's going to separate you from everybody else in the market. Any questions on life, homeowners insurance, long-term, any of this stuff, guys? All right, we will move on.
Great. So while you guys are collecting documents, you guys always get a copy of the 1040, right, Ryan?
The majority of the time, not always, but yes.
Yeah. And so when you're looking through that 1040, one areas that I think can really help you guys improve upon is, Ryan, if you want to go to the next screen, we'll share those, is as you're analyzing that 1040 or looking at it, hey, ask the client, do you contribute to a health savings account, HSA? How about charitable contributions? Did you know student loan interest is deductible? Or are you self-employed, or are you trying to start a side gig or a side, as they call it, right, a side hustle, right, Ryan?
Yep.
A little side hustle. Self-employment expenses, okay? So when where can you find these things? Schedule A, Schedule C, okay? So if you guys look at a 1040, and I don't know how much 1040 analysis and work you guys do, but at some point in the future, if you guys want, we can go through how do you look at a 1040? What are the most important areas to look at? And once you have the ability to understand a 1040, you can really help your clients make some recommendations. One of the big things in the Tax Cuts and Jobs Act, Ryan, was the increase of the standard deduction. Does that do you guys all talk? Do you guys talk about that? Do you know what that is?
Yep.
Great. So as that standard deduction has come up, it's become harder and harder for people to clear that $24,600 hurdle in terms of their deductions. And so educating them on what does become a deduction and a usable one, usable meaning over 24,600. So when you combine your state and your mortgage interest and your charitable contributions, student loan, HSA, once you surpass that 24,600, you get a larger deduction on your taxes. For those of you who are educating people on the art of home ownership, on assuming a mortgage, you say, okay, great. This is the number. This is the mortgage interest right here, Mr. and Mrs. Client, that goes on your Schedule A. All right, that number is 12,000 or 14,000. And then you can help them and say, hey, just so you know, by having this come here on your Schedule A, with your charitable contributions and your student loan interest, you've now exceeded the standard deduction limit, creating a larger deduction for you. That's powerful. That's really powerful. Secondly, don't forget about credits. So child tax credit is out there. Basically, if you have a kid, you get a tax credit. Residential energy credit. For those of you putting solar on your home, even window upgrades, there are credits out there for those things. I didn't want to get too far into the weeds in each one of these credits, Ryan, unless you guys want me to, but I think this is just a good place for you to say, interesting, what are other credits out there? So Google IRS tax credits, and there's a great website from the IRS that shows you all of the personal tax credits, homeowners tax credits, self-employment tax credits, okay? Education credits is another good one. So you send a kid to college, or you're paying for college for yourself, you get a deduction, a credit there.
Yeah, and guys, we're going to have a CPA come on a little bit later to dive more into this. And I know that it was helpful because this really should be a part of somebody's financial plan, is understanding how to take advantage of tax breaks and maximize tax benefits. But I think when it comes down to it, is obviously one of the questions that we ask on our client intake form is, are you confident that you're maximizing the tax benefits in your life right now? Most people aren't going to say yes to that. Most people will say, I'm not sure. I just kind of do my taxes every year, or I have someone do them. And that's a really easy way to then refer business over to your CPA. So we'll get more into that stuff as we get into that, have a CPA come on and do that session of it. But this was helpful from a high level tax perspective.
Ryan, that's a good point right there. And I'm just going to kind of expound upon that. A lot of you, especially the realtors, when you're selling homes for elderly people, one thing you may want to consider is the step up in basis. I don't know how much you talk about that, Ryan, but step up in basis basically says if you inherit a home and you're from your father or mother who passed away, when you go to sell that home, you don't have a tax burden because it steps up to fair market value on the date of their passing. So where I've really benefited and helped clients a lot is elderly couple, and maybe there's some health issues and they're thinking, oh boy, I need to sell this home and downsize, or I need to sell this property and move into a more of an assisted living situation. That typically will create a large capital gain for somebody, even with the $500,000 exclusion we see in this country. And so where we come and bring things to you, and Ryan, one of the most recent cases we referred to you was this exact situation. And we said, great, let's just assume a $300,000 mortgage on the property. And then maybe down the road, we'll rent it out to preserve the ability to step up in basis and not create a $200,000 tax burden.
Yep.
Okay. So step up in basis. If you guys haven't heard about it, give me a buzz. If you have heard about it or you want to Google it, it's a really powerful tool, especially when it comes to real estate. Lastly, we've gone through everything with the client. We've gone through their cash flow. We've gone through their insurances. Everything starts to come together. It's looking good. And you ask them the question, hey, how are you doing on your retirement? So what you have in front of you is a nice, easy to read, after I explain it probably, chart here that says, what level of assets should I have saved at various ages? So for example, you're working with a 40-year-old, they make $100,000. We simply look on the left-hand side, 40, we look at 100,000, we drop down here, the number's 2.9. What does this number represent? You should have 2.9 times the amount of your household income, which was that 100,000. So you should have $290,000 saved by the age of 40 if you make $100,000 a year. These numbers seem pretty high. They are the numbers, though, that keep you on track to retire by age 65. And the reason these numbers now have gone higher and higher and higher, Ryan, is basically longevity in our country. All right. People are living longer and longer now. And so you need more money for retirement, or you just work until you're 75, whichever you want to do.
And Jeff, are these numbers, that's to say that you have this and then you'll continue to have that $100,000 in retirement?
Yes.
Got it.
Yeah. So this is saying if you would like to maintain an equivalent lifestyle in retirement. So if we spend 100,000, I want that $100,000 lifestyle. Great. This is the number that I need to have at age 40. And then, you just work down that column. Okay, great. We're here at age 60. I need basically $1 million. 65, I need, $1.2 million. And now at this point, I can hopefully retire.
So that top line, the 50, 75, 100 is top line here. That's not your income. That's your expense, correct?
That's right. That's your lifestyle expenses. Yep.
Got it. Okay.
Yeah. So
guys, when you're talking to clients, obviously one of the big questions we ask is, Mr. Smith, I always ask my clients two questions. One is, do you know at what age you want to retire? And two, do you know how much money you're going to need from an income perspective at that time? And because I can't really do my job and give you really sound advice and guidance from a mortgage perspective if I don't take those factors into consideration. And if you're working with someone who's 30, 35, millennial, first-time home buyer, you may not need to dive as deeply into this, right? Because you can let them know, look, you have time, but I do want to let you know that, as we're helping you structure this mortgage, we want to keep that in mind, right? We want to keep in mind the fact that we don't want you to spend every last dime of yours on this home. We want you to have, money to be able to put away, to be able to save towards retirement. So, you have a very good financial livelihood moving forward. If you're talking to someone who's 55, 60 years old, you're going to have to dive into it a little bit more and more clear on that. But I think ultimately the goal should be to get every single person that you can to speak with your financial planner about creating a plan regardless of how old they are. Because the sooner you start, the better it becomes and the easier it becomes. You can see how much you need to save if you start when you're 60, right? It's a pretty difficult number to swallow. So definitely try and do that. And if they say, oh, I already work with a financial planner, best thing to do is ask, again, on a scale of 1 to 10, how valuable would you say your financial planner is? How often are you doing, annual reviews and checkups, and how proactive are they in helping you? Most of the time, you're not going to get that good of response, and then you can either refer them to your person, or if they say they're a 10, they're amazing, that's your opportunity to reach out to that person, create a relationship, and maybe end up putting them on your platform. Because over time, you can develop a relationship there. Plus, you create that synergy that Jeff was talking about in the beginning of the call.
Yeah, Ryan, and one of the main questions I do get, especially from referrals from you guys, is where should I start investing? Okay, so let's make this real easy, right? I would say 99 times out of 100, refer your client to their employer-sponsored 401k or 403b plan. Start with their employer 401k, start with their employer 403b, because typically you're going to have a matching, or you're going to have good investment lineups that have been audited by a fiduciary. So you're not just sitting there going, crud, where do I invest this money? Yeah, I want to start investing, but the first thing that people think of is, I'll go buy Amazon stock. I'll go buy Apple stock. It's actually not a bad idea because those companies have crushed it lately. But realistically, you want a well-diversified retirement portfolio. Ryan, start with your employer. Okay, 401k, 403b retirement plans. Those funds are fiduciarily audited. They are looked at. They are screened for expenses, and so it takes the guesswork, Ryan, out of the person who's got 50,000 or below. Send them there first. Then the second thing you want to do is, after they have looked at their 401k or their 403b and they like that concept, or they're getting the matching and it's coming out of their paycheck, we start to look at Roth IRAs. Again, I could do literally an hour just on the difference between Roth IRAs and traditional IRAs, Roth 401k, traditional 401k. That's not the goal here. The goal, unless you want it to be at some later point, the goal is basically to say, when someone says, where do I invest? Or how do I get started? Or, yeah, I want to start saving more for retirement. Hey, go investigate your employer 401k plan. I think that'd be a great place for you to start, Mr. and Mrs. Client. If you have questions on the difference between a traditional and Roth, contact Jeff Stanga. Contact, whoever it is that you're using as your local area partner.
Yeah, guys, this is huge because, again, you can't just ask the question, are you on pace for retirement? And then if they say, I'm not sure, say, well, hope you figure that out, right? You need to have some basic understanding of, okay, here's where I'd start, here's what I do. But more than anything, I think it'd be good to chat with a financial planner. And something Jeff said to me last night that I think was very eye-opening was that not every one of your clients should or needs to speak with a financial planner. Like, there's not a lot of financial planners that are going to be able to, from a capacity perspective, work with someone who has $100 a month in disposable income to put towards savings or retirement, right? So that's where you need to step in and say, look, if you have $100 to be able to invest or save, here's the best place to start, right? And then the goal will be, over time, as you ideally make more money, and as we ideally reduce your liabilities, and you can put more and more money away. Once you've contributed to your emergency fund, once you've started to max out your tax deferred retirement plans, and once we have that opportunity fund, right, or that real disposable income after all those buckets are full, right, and after insurance is paid for, then it's the time that you want to start looking at, okay, now let's speak with someone who can develop a plan and a strategy for me. Because, again, not all clients will have an incredible amount of disposable income to be able to put towards all these things and then still have additional money left over. And so I would say a good majority of the country won't. So I think it's important you guys understand that.